On September 30th, 2022, in the sweltering heat of Ouagadougou, a 34-year-old army captain named Ibrahim Traore stood before the cameras of the national television station. His uniform was dusty, his face was hard. He had just overthrown the government in a military coup. But he didn't speak like a typical African strongman hungry for power. He spoke like a man who had read the balance sheets of his country and discovered a crime scene. He said that Burkina Faso had been bled dry for too long. He said that the people deserved better than to be beggars sitting on a mountain of gold. Then, in February 2024, he said something that made the bankers in Paris sit up straight in their leather chairs. He said, "Perhaps everything we have done has surprised you, hasn't it? Don't worry, more changes are coming that might still surprise you. We will break every tie that has kept us in slavery." It was not a metaphor. It was a declaration of economic war. And the weapon he was about to deploy was not a gun. It was a currency. A new currency called the Sira, backed not by the promises of a foreign central bank, but by the gold dug from the soil of Burkina Faso itself. For the first time since independence, an African nation was about to do what had been considered impossible. It was going to break free from the CFA franc, and in doing so, it was going to threaten the entire architecture of French neocolonial control. To understand why this moment is so revolutionary, you have to understand the single greatest scam in the history of modern imperialism. You have to understand the CFA franc. The story begins on December 26, 1945. World War II had just ended. France had been humiliated, occupied by the Nazis, liberated by the Americans. The French Empire, which once stretched across Africa, Southeast Asia, and the Caribbean, was crumbling. Nationalist movements were rising everywhere. Independence was inevitable, but Charles de Gaulle, the proud and calculating leader of Free France, was not willing to let go of the wealth. He understood something that most colonial powers didn't grasp until it was too late. You don't need soldiers to control a country. You just need to control its money. So, on that December day in 1945, de Gaulle signed a decree creating a new currency for the French colonies in Africa. It was called the CFA franc. The acronym stood for Colonies Françaises d'Afrique, French colonies of Africa. The currency was pegged to the French franc at a fixed exchange rate. It was printed in France. And critically, the colonial governments were required to deposit their reserves in the French treasury. When the wave of independence swept across Africa in the 1960s, the French did something brilliant. They changed the name of the currency. CFA no longer stood for Colonies Françaises d'Afrique. It now stood for Communauté Financière Africaine, African Financial Community. They changed the branding, but they kept the chains. The newly independent nations of West and Central Africa were told they could keep using the CFA franc. It would provide stability, they said. It would prevent inflation, they promised. It would make trade easier. What they didn't say was that it would also allow France to continue extracting wealth from Africa without firing a single shot. By the 21st century, 14 African countries were using the CFA franc. In West Africa, the list included Benin, Burkina Faso, Guinea-Bissau, Ivory Coast, Mali, Niger, Senegal, and Togo. In Central Africa, it included Cameroon, Central African Republic, Chad, Congo-Brazzaville, Equatorial Guinea, and Gabon. Together, these countries represented over 180 million people, and every single one of them was trapped in a monetary system that was designed to benefit France, not them. The mechanics of the system are simple but devastating. First, the CFA franc is pegged to the euro at a fixed rate. This means that African countries cannot devalue their currency to make their exports more competitive. A cotton farmer in Burkina Faso is trying to sell his product on the global market, but his currency is tied to the euro, one of the strongest currencies in the world. Meanwhile, his competitor in India or Bangladesh has a weaker currency, which makes their cotton cheaper. The Burkina farmer loses the sale, his country stays poor. Second, and this is the most insidious part, the CFA countries are required to deposit at least 50% of their foreign exchange reserves in a special account at the French Treasury. This is not a loan. This is not an investment. It is a requirement. Think about the implications. Burkina Faso digs gold out of the ground. It sells that gold for dollars. But instead of keeping those dollars to invest in schools or hospitals or infrastructure, it has to send half of that money to Paris. France holds approximately 10 billion euros of African reserves in its vaults. And what does France do with that money? It borrows it at near zero interest rates to finance its own economy. Meanwhile, the African countries that actually own the money get a tiny interest payment in return, far below what they could earn if they invested it themselves. It is a system of legalized theft. But the scam doesn't stop there. Because France controls the central banks of the CFA zone, it also controls monetary policy. The Central Bank of West African States, which oversees the currency in countries like Burkina Faso, is not located in Ouagadougou or Dakar. It is effectively an extension of the Banque de France. When the African countries want to print more money or adjust interest rates to stimulate their economies, they have to get approval from a board that includes French officials. They are sovereign nations on paper. But in practice, they have less control over their own money supply than the state of California has over the US dollar. For decades, African intellectuals have screamed about the injustice of the CFA franc. Economists like Ndongo Samba Sylla from Senegal have spent their careers documenting the damage. Sylla argues that the CFA franc was not created for the benefit of African states, but to protect France against the rise of the US dollar. He points out that since independence, none of the CFA countries have achieved significant development. The highest income per capita these nations ever experienced was in the 1970s. Since then, they have stagnated or declined. Cheikh Nabia Tissé, a Malian economist, put it even more bluntly. He said it makes no economic sense for an independent country to deposit half of its foreign reserves in the bank of another country. It is a system designed to keep Africa as the cash cow of France. But whenever African leaders tried to break free, they were stopped, sometimes by economic pressure, sometimes by coups, sometimes by assassination. The most famous case is that of Thomas Sankara, the revolutionary president of Burkina Faso in the 1980s. Sankara was a visionary. He promoted self-reliance, women's rights, and economic independence. He refused to pay the foreign debts he said were illegitimate. He was wildly popular with his people. And in 1987, he was assassinated in a coup widely believed to have been backed by France. His successor, Blaise Compaoré, ruled for 27 years as a compliant French ally. In 1962, Mali tried to escape the system. Just 1 year after independence, the Malian government created its own currency, the Malian franc. It was an act of defiance, but the experiment failed. A combination of internal mismanagement, economic isolation, and relentless French pressure forced Mali to abandon the Malian franc in 1984 and rejoin the CFA zone. It was a warning to the rest of Africa. You cannot leave. Since then, no other country had dared to try. Until now. Ibrahim Traore is not the first African leader to criticize the CFA franc, but he is the first in a generation to actually take concrete steps to dismantle it. And he is not acting alone. In September 2023, the leaders of Burkina Faso, Mali, and Niger signed the Liptako-Gourma Charter. This agreement established a new alliance called the Alliance of Sahel States. It was initially framed as a defense pact to fight jihadist insurgencies, but Traore revealed that the alliance would evolve into a true economic, monetary, and political union. In November 2023, the finance ministers of the three countries issued a joint statement recommending the creation of a committee of experts to study the creation of a common currency. They proposed calling it the Sahel, but Burkina Faso is moving even faster. It is creating its own national currency first, the Sira. The name is symbolic. In the local Moore language, Sira means hope. It is a currency of liberation. But creating a currency is not as simple as printing banknotes. It requires dismantling decades of financial infrastructure and replacing it with something entirely new. And that is exactly what Traore has been doing. The first major step came in early 2024 with the establishment of the Burkina Faso Treasury Deposit Bank. This is not just a technical reform, it is a revolutionary act. For decades, the Central Bank of West African States, which is controlled by France, has managed the reserves and monetary policy of the CFA countries. These nations do not have independent central banks. The Treasury Deposit Bank changes that. It is a sovereign institution that will manage Burkina Faso's reserves, process transactions, and provide banking services directly to the government and the people. It has a network extending through regional, provincial, and departmental treasuries to ensure that everyone, regardless of location, can access financial services. But most importantly, it means that Burkina Faso will no longer have to deposit 50% of its reserves in a French bank. The money stays home. This was a direct slap in the face to Paris. And it was just the beginning. The second pillar of Traore's strategy is gold. Burkina Faso is one of the largest gold producers in Africa. Every year, tons of gold are extracted from the soil, but for decades that wealth left the country. Foreign mining companies, many of them French or Canadian, dug the gold out of the ground, shipped it abroad, and paid minimal royalties to the Burkina Faso government. The profits flowed to shareholders in Paris, Toronto, and London. The people of Burkina Faso saw almost nothing. Traore looked at this situation and asked a simple question. Why are we poor when we are sitting on a mountain of gold? The answer was obvious. The gold was being stolen. So he took action. In 2023, his government banned the export of unrefined gold. This was a bombshell. It meant that foreign mining companies could no longer simply dig up the ore and ship it out. They had to refine it in Burkina Faso. This kept the value-added process inside the country. It created jobs, it built technical capacity, and it ensured that the government could track and tax the gold more effectively. Then, in March 2024, the Burkina Faso government revised the 2015 mining code. The new regulations included a groundbreaking provision. Mining companies, including foreign ones, would be required to contribute to building a national gold reserve. This was not optional, it was mandatory. The companies had to hand over a portion of the gold they extracted to the state. This gold would be stockpiled in the vaults of the Treasury Deposit Bank, and it would be used to back the new currency. But Traore didn't stop there. He also invested in domestic gold refining capacity. In 2024, Burkina Faso announced that it had successfully processed mining residues, known as fine coal, from the Essakane mine. Fine coal is the leftover material after gold extraction. For years, it had been discarded as waste, but the Burkina Faso waste processing plant discovered that the fine coal still contained significant amounts of gold. They processed it and produced 44 gold bars, weighing a total of 93.197 kilograms. These bars were handed over to the Ministry of Economy. It was proof of concept. Burkina Faso could produce its own refined gold. It didn't need to rely on foreign refineries. The gold was there. The capacity was there. The only thing missing was the political will to seize control. And Ibrahim Traore had that in abundance. This strategy is brilliant for several reasons. First, unlike the CFA franc, which is backed by the euro and ultimately by the confidence of European financial markets, the Sira will be backed by something tangible. Gold. You can hold it in your hand. You can weigh it. You cannot print it into oblivion. A gold-backed currency imposes discipline on the government. It prevents reckless money printing and hyperinflation. This is critical for a country trying to build credibility. Second, Burkina Faso actually has gold. It has one of the richest deposits in Africa. By leveraging this natural resource, Traore is playing to his country's strengths. He is not trying to compete with the industrial economies of Europe or Asia. He is building a monetary system based on what Burkina Faso has. Third, a gold-backed currency has immense psychological power. For a continent that has been told for centuries that it is poor, that it needs aid, that it cannot manage its own affairs, a currency backed by African gold is a powerful symbol. It says, we are not beggars. We have wealth, we have value, we are not dependent. The reaction in Paris was swift and predictable. The French government did not issue official statements condemning Burkina Faso. That would have been too obvious. Instead, they deployed the weapons of soft power. The French media launched a propaganda campaign. Articles appeared in Le Monde, Le Figaro, and France 24 questioning Traore's competence. They called him a dictator. They said he was unstable. They painted a picture of Burkina Faso descending into chaos. The narrative was clear. This young soldier doesn't know what he's doing. He's going to destroy his country. The international financial press followed suit. The Financial Times, The Economist, and Bloomberg published op-eds warning of the dangers of a gold-backed currency. They said it was impractical. They said it would limit economic growth. They trotted out academic economists who explained in condescending tones why this was a bad idea. They said that modern economies need flexible monetary policy, and tying a currency to gold would prevent the government from responding to crises. But what they didn't say, what they couldn't say, was the real reason for their fear. If Burkina Faso succeeds, it will prove that a small, poor African country can break free from the Western financial system. It will prove that the CFA franc is a scam. It will prove that independence is possible. And if Burkina Faso succeeds, others will follow. Senegal will follow. Ivory Coast will follow. The entire CFA system will collapse. And with it, France's ability to extract billions of dollars from Africa every year. Behind the scenes, the French government deployed economic pressure. French banks, which dominate West Africa, began restricting lending to Burkina Faso. French companies, which control much of the telecommunications and energy infrastructure, threatened to pull out. The European Union, heavily influenced by France, warned that leaving the CFA could destabilize the region. The message was clear: stay in line or face the consequences. But Traore has advantages that previous African leaders did not. First, he has the people. The crowds in Ouagadougou are with him. The youth are with him. The memory of Thomas Sankara is still alive in Burkina Faso. People know their history. They know they have been exploited, and they are willing to endure hardship for the sake of true independence. Second, Traore has allies. Mali and Niger have also undergone military coups. They have also kicked out French troops. They have also joined the Alliance of Sahel states. These three countries represent a bloc of over 70 million people. If they act together, they are much harder to isolate. Third, and perhaps most importantly, Traore has options that did not exist in the 1960s or 1980s. The world is multipolar now. China and Russia are more than happy to provide an alternative to Western financial institutions. China has offered technical assistance in setting up the new central bank infrastructure. Russia has offered security expertise to protect the gold reserves from sabotage. This is not to say that Traore is replacing French dependence with Chinese or Russian dependence, but it does mean that he has leverage. He can play the great powers off against each other. He can diversify his partnerships. For decades, Africa had only one option: the West. Now, there are alternatives, but the path ahead is treacherous. Creating a new currency is one thing, making it work is another. According to Terence Hunk-Pono, an expert on monetary policy in West Africa, there are several key factors that must be in place for a new currency to succeed. First, macroeconomic and fiscal policy must be carefully coordinated. Burkina Faso, Mali, and Niger will have to closely align their economic and budgetary policies to ensure currency stability and eliminate trade imbalances. This is difficult, even for advanced economies. For 3 poor countries emerging from conflict, it is a monumental challenge. Second, strong monetary management institutions must be established. There needs to be a credible central bank with sufficient authority to conduct independent and stable monetary policy. This central bank must be insulated from political pressure. It must have competent staff. It must have modern technology. Building this from scratch takes time and expertise. Third, the countries need to establish a unified single market. This means the free movement of goods, services, capital, and labor across borders. The Alliance of Sahel States is working on this, but it requires dismantling decades of trade barriers and regulatory differences. Fourth, mechanisms for crisis management must be put in place. Common reserve funds and currency swap arrangements can help mitigate external and internal shocks. But these require trust and coordination. If one country cheats or free rides, the system collapses. These are serious challenges, but they are not insurmountable. And the alternative, staying in the CFA system, is no longer acceptable. There's also a broader historical lesson here. Gold-backed currencies have a mixed track record. In the 19th century, the gold standard provided stability and facilitated international trade. But it also meant that countries could not respond to economic crises by adjusting their money supply. During the Great Depression, the countries that abandoned the gold standard first recovered fastest. On the other hand, fiat currencies managed by reckless governments have an even worse track record. Look at Zimbabwe, Venezuela, or Weimar Germany. When governments print money without restraint, hyperinflation destroys the economy. A gold-backed currency, if managed properly, prevents that. It imposes discipline. For Burkina Faso, the appeal is clear. The country has gold. It doesn't have a sophisticated industrial base. It doesn't have vast oil reserves like Nigeria. But it has gold. By backing the currency with gold, Traore is leveraging the one asset Burkina Faso has in abundance. There is also a powerful symbolic dimension. A gold-backed currency is not just an economic tool. It is a statement. It says, and we are not a vassal state. We are not a client. We have something real, in a continent that has been told for centuries that it is poor, that it is primitive, that it needs the guidance of Europe. This symbolism matters. It is a psychological break from colonialism. But symbols don't pay salaries or buy medicine. The real test is whether the Sira can facilitate trade, attract investment, and improve people's lives, and that depends on whether other countries accept it. If the Sira is only used inside Burkina Faso, it will struggle. Trade will be difficult. Merchants will demand payment in dollars or euros. Inflation could spike if confidence collapses. But if Mali and Niger adopt the same currency, or if they coordinate their monetary policies closely, it creates a regional bloc. If Senegal and Ivory Coast eventually follow, it becomes a major economic zone that cannot be ignored. The French are betting on isolation. They are pressuring the other CFA countries to stay in line. They are offering loans, investment, and political support to countries that remain loyal. They are making it clear that anyone who follows Traore will face economic warfare. In 2019, there was a moment of hope. Ivory Coast President Alassane Ouattara and French President Emmanuel Macron held a joint press conference. They announced that the CFA franc as it had existed was no more. The Central Bank of West African states would no longer be required to deposit reserves in the French Treasury. The currency would be renamed the ECO. France would withdraw from the governance structures. It sounded like progress. It sounded like reform, but it was a lie. It is now 2025. The CFA franc has not been renamed. The reserves are still in Paris. The governance structure is unchanged. Nothing has changed. It was a public relations stunt designed to diffuse the growing anger across Francophone Africa. And it failed. The people are not stupid. They can see that their money is still controlled by foreigners. This is why Ibrahim Traore's move is so significant. He is not asking for reform. He is not negotiating for better terms. He is simply walking away. He is building a parallel system, and he is daring France to stop him. One of the most underreported aspects of this story is the role of the African diaspora. Millions of Africans live in Europe and North America. They send billions of dollars home every year in remittances. These remittances are a lifeline for countless families, but they are also a mechanism of control. Most remittances are sent through Western companies like Western Union or MoneyGram, which charge exorbitant fees. A worker in Paris might send 100 euros home to his family in Ouagadougou, but after the fees and the exchange rate markup, his family receives only 85 euros. The rest is siphoned off by intermediaries. If Burkina Faso successfully launches a gold-backed digital currency, it could create a parallel remittance system. People could send money directly, peer-to-peer, using blockchain technology. The fees would be minimal, the exchange rate would be transparent. This would bypass the Western financial system entirely, and it would save African families billions of dollars every year. This is the future of money, and it terrifies the gatekeepers. The rise of cryptocurrency and blockchain technology has made it possible for small countries to create sovereign currencies without needing the approval of the IMF or the World Bank. It is a revolutionary moment, and Traore understands this. He's not just thinking about paper money, he is thinking about digital infrastructure. As of now, the Sira has not been fully launched. The printing presses are being set up. The gold reserves are being accumulated. The Treasury Deposit Bank is operational, but the transition from the CFA franc to the Sira is still underway. It is a delicate process. If it is rushed, it could fail. If it is delayed too long, the momentum could be lost. Traore is walking a tightrope. Meanwhile, the French are doing everything they can to undermine the effort. They are funding opposition groups inside Burkina Faso. They are spreading disinformation on social media. They are preparing economic sanctions. They are lobbying other African countries to isolate Burkina Faso. But Traore has one thing that the technocrats in Paris do not have. He has legitimacy. The people of Burkina Faso believe in him. They see him as the heir to Thomas Sankara. They see him as the man who is finally finishing what Sankara started, and they are willing to endure hardship for the sake of sovereignty. This is not just an economic policy, it is a movement. It is a reckoning with history. For 75 years, France has extracted wealth from Africa through the mechanism of the CFA franc. For 75 years, African leaders who tried to break free were destroyed. But now a new generation has risen, a generation that grew up with the internet, a generation that can see what is happening in the rest of the world, a generation that refuses to accept the old excuses. Will Ibrahim Traore succeed? History will judge. But one thing is certain. The conversation has changed. For the first time in decades, Africans are asking the forbidden question. Why are we poor when we have so much wealth? And the answer, more and more people are realizing, is that the wealth has been stolen, not with guns, but with banks, not with soldiers, but with currency. The CFA franc was the most elegant theft in history. It allowed France to extract billions of dollars without firing a shot. But now, the victims are waking up. And when they wake up, empires fall. The French economy, built in part on the hidden subsidy of African reserves, is facing a reckoning. If the CFA system collapses, France loses access to cheap capital. It loses political leverage. It loses the ability to punch above its weight on the global stage. For Burkina Faso and its neighbors, the road ahead is hard. Creating a new currency is the easy part. Making it work is the challenge. They will face sabotage. They will face isolation. They will face economic warfare. But they will also have something that no amount of money can buy. They will have their dignity. And in the long run, dignity is more powerful than debt. This is not the end of the story. It is the beginning. The Sira is hope. And hope, once planted in the soil of Africa, is very difficult to kill.